Beloved seekers of financial wisdom, dear family of prudent builders and patient investors, there is a moment in every investor's life when the world turns upside down, when everything you thought was solid becomes liquid, when the assets everyone said would make you rich suddenly threaten to make you poor. And in that moment, the ones who survive, the ones who thrive, the ones who see opportunity while others see only disaster, they all have one thing in common. T.G. Farga and Ipo, they have cash. Simple, boring, unfashionable cash. And that cash becomes their greatest weapon. Let me tell you something that goes against everything you've been hearing lately. Something that will make the financial gurus scoff. Something that contradicts the prevailing wisdom of our time. Cash is not trash. Cash is not a depreciating asset to be avoided. Cash is not the enemy of wealth. Cash, properly understood and properly deployed, is one of the most powerful tools in your investment arsenal. It is the ammunition that allows you to strike when others are retreating. It is the cushion that lets you sleep peacefully when markets are convulsing. It is the opportunity fund that turns disasters into fortunes. But we live in strange times, times when holding cash is ridiculed, when every financial influencer tells you that cash is losing value to inflation, when the entire investment industrial complex pushes you to be fully invested always, in everything, all the time. And I'm here to tell you that's dangerous, that's reckless, that's a recipe for disaster when the inevitable crash comes. Because crashes always come, always, not maybe, not possibly, certainly, with mathematical inevitability. And when they come, the investors with cash become kings, while everyone else is forced to sell at the bottom, forced to realize losses, forced to watch helplessly as their wealth evaporates. The cash holders are buying, accumulating, building fortunes that will compound for decades. That's the truth they don't want you to understand. Because if you understood it, you might not stay fully invested in the market. You might not keep buying during bubbles. You might not keep feeding the machine that makes them rich. But I'm old enough, and I've seen enough to tell you the uncomfortable truth. Let me take you back to a moment that taught me this lesson in the most painful way possible. It was 2007. I was sitting in a meeting with a very successful businessman, self-made, brilliant in his industry. His company was worth tens of millions on paper. His stock portfolio was worth several million more. His real estate holdings were substantial. He felt invincible, wealthy beyond what he'd ever imagined as a young man, and he was telling me about his plans, the expansion he was financing, the investments he was making, the lifestyle he was building. I asked him one question: how much liquid cash do you have? Real cash, not lines of credit, not the theoretical value of your assets. Actual cash you could access tomorrow. He looked uncomfortable. He mumbled something about everything being invested, about how foolish it would be to hold cash earning nothing when his investments were appreciating. Then 2008 happened. The financial crisis, the collapse, the panic. His business needed cash to survive the downturn. His investments were down 70%, and selling them meant locking in catastrophic losses. His real estate was underwater, unsellable. His lines of credit were pulled by panicking banks. He had built an empire on sand. And when the tide went out, he had nothing solid to stand on. Within 18 months, he'd lost everything, not because his business was bad, not because his investments were foolish, but because he had no cash, no buffer, no ammunition to weather the storm or take advantage of the opportunities that crashes always create. I watched other investors, ones who'd been mocked for holding 20, 30, even 40% in cash. I watched them buy assets for pennies on the dollar. Real estate, stocks, businesses, things that would compound into fortunes over the next decade. The difference between the two groups wasn't intelligence, wasn't luck. It was simply this one group had cash when it mattered most. The other group didn't. That lesson, I've never forgotten it, and it shaped how I've thought about investing ever since. Now, I know what you're thinking. You're thinking about inflation, about how cash loses purchasing power, about how the experts say you're being destroyed by holding cash. And there's truth in that concern. Cash held forever is indeed eroded by inflation. In a normal environment, inflation runs at 2 to 4% annually. Your cash loses value in real terms. But here's what they don't tell you. Here's the nuance that changes everything. The question is not whether to hold cash forever. The question is whether to hold cash strategically. To maintain enough liquidity that you have options when markets panic. Enough dry powder that you can be greedy when others are fearful. And the cost of that optionality, the 2 to 4% erosion during normal times, is nothing compared to the opportunities it creates during abnormal times. Let me show you the mathematics of this, because this is where most people get confused. They see the slow erosion of cash and think they're losing, but they're not calculating what they're gaining. Imagine you hold 20% of your portfolio in cash. In a normal year, that cash loses maybe 3% to inflation. On $1 million portfolio, that's $6,000 of purchasing power lost. That sounds bad, until you understand what you're buying with that $6,000. You're buying the ability to sleep at night when markets drop 30%. You're buying the freedom to hold your stock positions without panic, because you're not dependent on selling them for living expenses. You're buying the ammunition to deploy when assets go on sale. And here's the critical part. You don't pay that $6,000 cost every year. You pay it only until the crash comes. And when the crash comes to, and you deploy that cash into assets at 40, 50, 60% discounts, you make back decades worth of inflation losses in a single transaction. One well-timed deployment of cash during a crisis can generate returns that dwarf anything you lost to inflation while waiting. But you have to be patient. You have to be willing to look foolish for years, holding cash while everyone else is making money in a rising market. You have to resist the siren song of FOMO, of fear of missing out. That psychological discipline, that's the real challenge, not the mathematics. The mathematics are simple. It's the emotional fortitude to maintain cash when everyone is telling you you're an idiot for doing so. I remember 2017, 2018, 2019. The stock market was screaming higher. Bitcoin was going parabolic. Real estate was breaking records. Everyone was getting rich, or so it seemed. And there I was holding cash, lots of it, waiting, watching valuations climb to absurd levels, listening to people tell me I was missing out, that this time was different, that the old rules didn't apply anymore. But I'd seen it before. I knew how the story ended. I knew that trees don't grow to the sky, that what goes up on borrowed money and euphoria eventually comes down on panic and forced selling. So I waited. And yes, it was uncomfortable. Yes, I questioned myself. Yes, I wondered if maybe, just maybe, I was wrong this time. Then March 2020 happened, the COVID crash. Markets dropped 35% in a month. Panic was everywhere. Forced liquidations, margin calls, redemptions, chaos, and I had cash, lots of it, ready, waiting. Deployed methodically as prices fell, buying world-class businesses at prices I hadn't seen in a decade. Those investments, many of them doubled or tripled in the recovery. That cash I'd held for 3 years, slowly eroding to inflation. It generated returns that more than compensated for a decade of inflation loss. That's the power of strategic cash. That's why cash is king. Not because holding it forever is optimal, but because having it when crashes come creates opportunities that nothing else can match. Now let me be clear about something important. I'm not saying hold all your money in cash. I'm not advocating market timing in the traditional sense, where you try to predict exact tops and bottoms. What I'm advocating is maintaining a permanent strategic cash allocation, a war chest, an opportunity fund. Call it what you will. But always have it, always. For most investors, I'd suggest something like this: 20 to 30% in cash or short-term treasury bills during normal markets. More if valuations are extreme. Less if we're already in a crash and opportunities are abundant. But never zero, never fully invested. Never in a position where you're forced to sell holdings because you need liquidity. Because that's when the market destroys you. When you're forced to sell. When you have no choice. When your back is against the wall. The investor with cash is never forced, never desperate, never at the mercy of market timing. And that freedom, that optionality, is worth far more than the slow erosion of inflation. Let me tell you about the psychology of cash, because this is where it gets really interesting, where the benefits extend beyond just financial returns. When you have a substantial cash position, your entire relationship with investing changes. You stop fearing market volatility. You start welcoming it. Drops in prices don't feel like losses. They feel like buying opportunities. This psychological shift is profound. It transforms you from a reactive investor into a strategic one, from someone who panics during crashes to someone who profits from them. I've watched investors with no cash positions agonize over every market wiggle. Should they sell? Should they buy? What if it drops more? What if they're too late? The anxiety is constant, exhausting, wealth destroying. But investors with substantial cash, they're calm, patient, opportunistic. They have a plan. They know what they'll buy if prices reach certain levels. They're not reacting, they're executing. That peace of mind, you cannot put a price on it. It's the difference between investing being a source of stress versus a source of confidence. And here's something else that cash provides: protection against yourself. Most investment losses don't come from market crashes. They come from behavioral mistakes. Buying high because of greed, selling low because of fear, chasing trends, making emotional decisions. Cash protects you from these mistakes. How? Because when you have cash, you're never desperate. You're never forced into a decision by circumstances. You always have time to think, to analyze, to be rational. The investor with no cash facing an unexpected expense or opportunity has to make hasty decisions. Sell stocks at an inopportune time. Miss an opportunity. Take on debt at bad terms. The investor with cash handles these situations calmly, deploys cash when appropriate, maintains portfolio discipline, avoids forced errors. Over a lifetime of investing, avoiding a handful of major behavioral mistakes is worth more than optimizing every dollar for maximum return. Cash helps you avoid those mistakes. Now let me address another common objection. People say, but what about dollar cost averaging? What about staying invested through cycles? What about time in the market beating timing the market? These are valid principles. For the average investor who can't or won't actively manage their portfolio, staying fully invested in a diversified index and adding regularly is indeed the right approach. But we're talking about something different here. We're talking about sophisticated investors who are willing to maintain discipline, watch markets carefully, and deploy capital strategically during opportunities. For those investors, strategic cash positions enhance returns rather than diminish them, because they're not trying to time every move. They're simply maintaining ammunition for the obvious opportunities that periodically present themselves. The two strategies aren't contradictory. You can dollar cost average into your core positions while maintaining a separate opportunity fund in cash. You can stay invested in quality businesses for the long term while keeping powder dry for exceptional situations. The key is not being dogmatic, not being all in on one approach, being flexible, being strategic, opportunistic, and that requires cash always. Let me tell you something that most investors never learn, something that separates the truly wealthy from those who merely accumulate and lose over and over again. Wealth is not built by always being invested. Wealth is built by knowing when to be invested and when to wait. And waiting, that requires cash. There's a famous saying often attributed to the Rothschild banking family. The time to buy is when there's blood in the streets. But here's what that saying assumes. It assumes you have cash to deploy when there's blood in the streets. If you're fully invested when the panic comes, when the opportunities arrive, when assets are being given away, you're just another victim watching from the sidelines. Or worse, you're one of the people being forced to sell, creating the very opportunities that others will profit from. I want to take you through the anatomy of a market crash, because understanding this, really understanding it, will change how you think about cash forever. A crash doesn't happen randomly. It follows a predictable pattern. First comes the euphoria phase. Everyone is making money. Valuations don't matter anymore. This time is different. New paradigms, revolutionary technologies. Can't miss opportunities. During this phase, holding cash feels absolutely foolish. Your neighbors are getting rich. Your friends are bragging about their returns. Financial media is celebrating the genius of fully invested portfolios. Every day you hold cash, you're losing, because you're not participating in the rally. This is the test. This is where 99% of investors fail. They cannot withstand the social pressure, the psychological discomfort, the fear of missing out, so they deploy their cash. They go all in. They convince themselves that this time really is different. Then comes the crack, some unexpected event, some revelation, some catalyst that causes the first group of investors to question whether prices make sense. Smart money starts exiting, quietly, without fanfare. They don't announce it. They just sell, methodically, into strength while everyone else is still buying. Then comes the realization phase. More investors start noticing something is wrong. Prices aren't going up anymore. They're volatile, scary. The narratives that justified extreme valuation start crumbling. Doubt creeps in. This is when leverage starts causing problems. Investors who borrowed to maximize returns find themselves getting margin calls. They're forced to sell, not because they want to, because they have to. And forced selling begets more forced selling. Then comes the panic, full, unrestrained terror. Everyone rushing for the exits at once. Prices collapsing. Fortunes evaporating. The financial media, which was celebrating genius just months ago, now prophesying doom. And here's the critical moment. Here's where cash becomes king. During the panic phase, everything gets sold. The good businesses, the bad businesses, the fairly priced assets, the undervalued assets, everything. Why? Because people need cash. Margin calls demand cash. Redemptions require cash. Fear produces a desperate scramble for liquidity. And in that scramble, prices become irrational, disconnected from fundamental value. A business that was trading at 15 times earnings might drop to 5 times earnings. Not because the business changed, not because its future prospects deteriorated, simply because everyone needs cash and nobody has it, except you. You have cash, because you were patient, because you were disciplined, because you resisted the euphoria. And now you can buy incredible businesses at prices that won't be available again for years, maybe decades. This is how generational wealth is built. Not by being fully invested all the time, but by having cash when crashes come and deploying it ruthlessly into the best opportunities. Let me give you a concrete example from my own experience. In March 2009, at the depths of the financial crisis, I was able to buy shares in some of the best businesses in America at valuations that were absolutely absurd. Financial companies trading at 40% of book value. Technology companies at 8 times earnings. Dividend-paying blue chips yielding 7, 8, 9%. It was like shopping at a 90% off sale for quality goods. But I could only do that because I had cash. Lots of it. I'd been holding it for 2 years while everyone told me I was an idiot. While the market kept going up and I kept missing out. While my returns lagged and my strategy seemed foolish. Those investments I made in March 2009, many of them generated returns of 300, 400, 500% over the next decade. Some even more. Now let me ask you a question. Would you be willing to underperform the market for 2 or 3 years if you knew that at the end of that period, you'd be able to generate those kinds of returns? Of course you would. Anyone would. But in real time, when you don't know when the opportunity will come, maintaining that discipline is incredibly difficult. That's why most investors fail. Not because they don't understand the strategy, but because they can't execute it. They can't maintain the discipline. They can't withstand the psychological discomfort of holding cash when everyone else is making money. But that discomfort, that's the price of optionality. That's the cost of having ammunition when opportunities arise. And it's a small price to pay for the returns that strategic cash deployment generates. Now let me talk about something that makes holding cash even more powerful in today's environment. Something that most investors aren't considering. We live in a world of unprecedented everything. Unprecedented debt levels, unprecedented asset prices, unprecedented monetary policy, unprecedented speculation. The stock market is at all-time highs. Real estate is at all-time highs. Cryptocurrency markets are enormous. Private equity valuations are extreme. Everything, everywhere, is expensive by historical standards. Does this mean a crash is imminent? No. Markets can stay irrational longer than you can stay solvent, as the saying goes. Bubbles can inflate far beyond what seems possible. But it does mean that the asymmetry of returns is terrible right now. The potential upside from already elevated prices is limited. The potential downside is substantial. When expected returns are low and risks are high, holding cash becomes not just strategic but prudent. You're not missing much upside, and you're protecting yourself from significant downside. This is what intelligent investors do. They assess risk-reward ratios. When the ratios are favorable, they invest heavily. When the ratios are unfavorable, they hold cash and wait. Mechanical investors, who are always fully invested regardless of valuation, might do fine in the long run through sheer time and compound interest. But strategic investors, who modulate their cash positions based on opportunity sets, typically do much better. Now let me tell you about the different types of cash positions and when to use each. Emergency cash is the foundation. 3 to 6 months of living expenses in a savings account or money market fund. This isn't investment capital. This is life capital. Protection against job loss, medical emergencies, unexpected expenses. Never touch this. Never invest it. This is your security blanket. Opportunity cash is different. This is capital earmarked for investing, held in reserve waiting for compelling opportunities. This might be 10, 20, 30, even 50% of your investable assets during bubble periods. This cash can be held in several forms. Traditional savings accounts, though the interest is minimal. Money market funds, which offer slightly better yields. Short-term treasury bills, which are currently offering reasonable yields and are backed by the full faith and credit of the U.S. government. The key is that this cash is liquid and safe. You're not reaching for yield. You're not taking credit risk. You're preserving capital and optionality. Then there's tactical cash. This is cash you raise by selling positions that have reached your price targets or that have become overvalued. You're not selling because you're predicting a crash. You're selling because prices have exceeded what you think is reasonable, and you'd rather hold cash than overvalued assets. This tactical cash is constantly rotating. You sell when prices are high. You buy when prices are low. You maintain discipline around valuation rather than trying to predict market movements. All three types of cash serve different purposes. All three are important, and together they create a fortress of financial security that very few investors possess. Let me tell you a story about a woman I advised decades ago. She was a physician, earned a good income, saved diligently, but she made the mistake of being fully invested all the time. Every dollar that came in went immediately into stocks. No cash cushion beyond a small emergency fund. She believed she was being optimal, maximizing her returns, following conventional wisdom. Then she lost her job unexpectedly. Hospital politics, nothing to do with her competence. But suddenly her income stopped, and she needed cash to live on while she searched for a new position. She had no choice but to sell stocks. Unfortunately, this happened during a market downturn. She locked in losses, sold good companies at bad prices, destroyed years of compound growth because she needed liquidity. If she'd maintained even a modest cash position, say 20% of her portfolio, she could have lived on that for over a year while her stocks recovered. She could have avoided the forced selling, avoided the realized losses, but she didn't understand the value of cash. She thought it was dead money, wasted opportunity, and that misunderstanding cost her dearly. After that experience, she changed her approach. She always maintained substantial cash positions. And you know what happened. Her stress levels dropped dramatically. Her investment returns actually improved because she was no longer making desperate decisions. Her entire financial life became more stable. That's the paradox of cash. You think it's costing you returns. But properly deployed, it actually enhances returns by preventing mistakes and enabling opportunistic purchases. Now, let me address the inflation argument more directly, because I know this is what keeps people from holding cash. They're terrified of inflation eroding their purchasing power. And yes, inflation is real. Yes, cash loses purchasing power over time in an inflationary environment. This is an undeniable mathematical fact. But here's what you need to understand. The inflation rate that matters for your cash holdings is not the annual CPI number. It's the inflation-adjusted opportunity cost over the holding period until deployment. Let me explain with numbers. Say you hold cash for 3 years and inflation runs at 4% annually. Your cash loses about 12% of purchasing power over that period. That sounds terrible, until you deploy that cash during a market crash and buy assets at 50% discounts. Now you've not only recovered your inflation losses, but generated a net gain of 38% relative to staying fully invested. And that's a conservative scenario. In severe crashes, assets can drop 60, 70, even 80% from their peaks. Your inflation losses become trivial compared to the opportunities created. But there's something else people miss. Inflation doesn't run at a constant rate. It ebbs and flows. During periods of economic stress, when crashes typically occur, inflation often moderates or even turns to deflation. So the very times when you're most likely to deploy your cash, inflation is less of a concern. The times when inflation runs hot, Those are typically boom times when you should be raising cash, not deploying it. The strategy is self-correcting in this regard. You're holding cash during periods when its erosion is minimal and deploying it during periods when its purchasing power is actually increasing relative to assets. This timing isn't perfect. You can't predict it precisely, but the general pattern holds. And over multiple cycles, the mathematics work strongly in favor of strategic cash holdings. Now let me tell you about the psychological benefits of cash that nobody talks about. Benefits that have nothing to do with returns, but everything to do with the quality of your life. When you have substantial cash reserves, you make different decisions. Better decisions. You're not desperate, not grasping, not afraid. You can walk away from bad deals because you don't need them. You can negotiate from strength because you have alternatives. You can wait for the right opportunity because you're not pressured by circumstances. This applies to investments. It applies to business decisions. It applies to career choices. Cash gives you power. The power to say no, the power to wait, the power to choose. I've watched people make terrible decisions, take terrible jobs, accept terrible terms, invest in terrible deals, all because they needed money immediately. They had no cash cushion, no breathing room, no options. And I've watched people with cash make brilliant decisions, walking away from overpriced acquisitions, waiting years for the right opportunity, negotiating terms that others couldn't get because they had the luxury of being patient. That's the hidden value of cash. It's not just about financial returns. It's about life returns. The quality of decisions you can make when you're not operating from desperation. There's a concept in negotiation theory called BATNA, best alternative to a negotiated agreement. Your BATA is what you can do if the current deal doesn't work out. The better your BATNA, the stronger your negotiating position. Cash is your financial BATNA. It's what allows you to walk away, to wait, to demand better terms, to act from strength rather than weakness. And that strength, that optionality, compounds over a lifetime into enormous advantage. Now we come to the heart of the matter, the deeper truth about cash that transcends mere financial strategy, because holding cash, truly understanding its power, requires a transformation in how you think about wealth, about markets, about yourself. Most people see investing as a passive activity. You put money in, you hope it grows. You check your statements, you react to what happens. But strategic cash management transforms investing into something different, something active, something warrior-like. You're no longer at the mercy of markets. You're positioned to exploit them. You're not hoping for good outcomes. You're creating conditions where good outcomes become inevitable. This requires a complete shift in mindset, from victim to victor, from passive to active, from reactive to strategic. Let me tell you about a conversation I had many years ago with a man who'd built enormous wealth, self-made, started with nothing. And he told me something I've never forgotten. He said, "The market is a battlefield. Most people don't realize they're in a battle. They think they're in a cooperative endeavor where everyone wins together. But that's not reality. For every winner in the market, there's a loser on the other side. Someone who sold too early, someone who bought too late, someone who panicked, someone who got greedy." He continued, "The key to winning battles is ammunition. In war, it's bullets and shells. In markets, it's cash. If you run out of ammunition in the middle of a battle, you lose. Doesn't matter how brave you are. Doesn't matter how smart your strategy is. No ammunition means defeat." That analogy struck me deeply, because it's exactly right. Markets are adversarial. They're Darwinian. They reward the prepared and punish the reckless. And being prepared means having ammunition when it matters most. But here's what makes this difficult. In war, the enemy is obvious. You know you're in a battle. Your survival instincts are engaged. You naturally prepare, stay alert, maintain supplies. In markets, the enemy is invisible. It's complacency. It's euphoria. It's the seductive belief that good times will last forever. It's the voices telling you that holding cash is foolish because this time is different. So you let your guard down. You deploy all your ammunition during peacetime. You convince yourself that battles are a thing of the past. And then the battle comes. And you're defenseless. The disciplined investor, the strategic investor, never makes this mistake. They always maintain cash, always. Not because they're predicting a crash, but because they know crashes are inevitable. They don't know when. They don't need to know when. They just know they'll come. And when they come, the prepared investor becomes wealthy, while the unprepared investor becomes a cautionary tale. This brings me to something crucial: the relationship between cash and courage. You might think that holding cash is a fearful position, a defensive crouch, a lack of confidence in the future. But it's exactly the opposite. Holding cash when everyone else is fully invested requires enormous courage. It requires the courage to be different, to be mocked, to watch others make money while you wait, to trust your own analysis over the crowd's enthusiasm. And then, when the crash comes and everyone is terrified, deploying that cash requires even more courage. Because now you're buying when everyone else is selling. You're being greedy when others are fearful. You're committing capital when the consensus says the world is ending. Both phases require courage. The courage of patience and the courage of conviction. Most investors have neither. They lack the courage to hold cash during booms, so they're fully invested. Then they lack the courage to deploy during crashes, so they hold cash at the bottom. They do everything backwards. And they wonder why they never build wealth. The investor who understands cash, who truly understands it, develops a different kind of courage, a quiet, patient, strategic courage that doesn't need validation from others. That doesn't need the market to immediately prove them right. That can wait years for the setup to materialize. This courage comes from deep knowledge, from studying market history, from understanding cycles, from recognizing that patterns repeat because human psychology doesn't change, from accepting that extreme valuations eventually revert to the mean, always, without exception. When you have this knowledge, this understanding, holding cash doesn't feel fearful. It feels powerful. You're not scared of markets. You're positioned to exploit them. You're the hunter, not the prey. Let me share with you some specific rules I've developed over decades about when to hold more cash and when to deploy it. These aren't rigid formulas. They're guidelines, principles, frameworks for thinking. Rule 1: when everyone is comfortable, be cautious. When fear is absent from markets, danger is present. Complacency breeds risk-taking. Risk-taking at extreme levels creates bubbles. Bubbles always burst. So when you see universal comfort and confidence, that's when you should be raising cash. Rule 2: when valuations are extreme by historical standards, hold extra cash. What does extreme mean? When stock market capitalization exceeds GDP by significant margins. When price-to-earnings ratios are in the top decile of historical ranges. When dividend yields are in the bottom decile. When nobody cares about valuation because growth justifies any price. These are warning signs, not timing signals, but warning signs that suggest raising cash is prudent. Rule 3: when leverage is pervasive, maintain large cash reserves. Leverage amplifies movements in both directions. When everyone is borrowing to invest, small declines trigger cascading force selling. This creates opportunities for those with cash. So monitor margin debt, monitor corporate leverage, monitor private equity leverage. When it's elevated everywhere, danger lurks. Rule 4: when speculation becomes mainstream, raise cash aggressively. What does this look like? When your barber is giving you stock tips. When taxi drivers are trading options. When cryptocurrencies nobody understands are making people overnight millionaires. When people quit their jobs to day trade. These aren't signs of a healthy market. They're signs of a mania. And manias end badly always. Rule 5: when assets go on sale, deploy cash methodically. Don't try to catch the exact bottom. You can't. Nobody can. But when quality businesses drop 30, 40, 50% from their highs, start buying. Scale in. Use the cash you've been holding. Don't wait for perfect certainty. It never comes. Deploy into fear, into panic, into blood in the streets. Rule 6: after deploying cash during a crisis, immediately begin rebuilding your cash position. As markets recover and your investments gain value, take some profits. Rotate back into cash. Prepare for the next cycle. Because there's always a next cycle. Always. These rules, followed with discipline, will serve you well across decades of investing. They're not complicated. But they're hard to execute because they require you to act contrary to the crowd, contrary to your emotions, contrary to the prevailing narrative. But that's exactly why they work. If they were easy, everyone would do them. And if everyone did them, they wouldn't work anymore. The difficulty is the moat. The psychological challenge is what creates the opportunity. Now let me address something important. The difference between strategic cash and market timing. Because people often confuse the two, and they're very different. Market timing is trying to predict short-term movements. Selling because you think a correction is coming next month. Buying because you think a rally will start next week. It's active, frequent, prediction-based decision-making. And it doesn't work. Study after study shows that market timers underperform. Why? Because short-term market movements are essentially random, driven by unpredictable news flow, emotional reactions, technical factors. Nobody can consistently predict them. Strategic cash management is different. You're not predicting when crashes will happen. You're preparing for the inevitable fact that they will happen. You're not trying to sell the top and buy the bottom. You're maintaining ammunition for obvious opportunities when they arise. The difference is philosophical. Market timing assumes you can predict. Strategic cash management assumes you can't predict timing, but you can prepare for eventual certainty. Market timing is gambling. Strategic cash management is war preparation. They look similar on the surface, but they're fundamentally different in intent, execution, and results. I never try to predict market tops or bottoms. I've learned that lesson the hard way. But I always maintain cash because I know that eventually, without fail, opportunities will present themselves. And when they do, I want to be ready. That's not market timing. That's strategic positioning. That's understanding probabilities and cycles and human nature. That's being a prepared investor rather than a reactive one. Let me tell you one more story. A story that encapsulates everything we've discussed. A story about two investors, both of whom I knew personally. Investor A believed in staying fully invested always. Maximum exposure to growth assets. No cash except a small emergency fund. His reasoning was sound, based on long-term data showing that stocks outperform cash over time. He was mathematically correct about this. And for years, his portfolio grew faster than Investor B's. Investor B maintained a 20 to 30% cash position always. During bull markets, he underperformed Investor A. His friends thought he was overly cautious, missing out on gains. But he was patient, disciplined, unmoved by criticism. Then 2008 happened. Both investors had roughly $1 million when the crisis began. Both held quality stocks, not speculative junk. Investor A, fully invested, watched his portfolio drop to $600,000. No cash to buy the bargains. No ability to dollar cost average into falling prices. Just paralyzed horror as his wealth evaporated. He eventually sold near the bottom, unable to psychologically handle more losses. He locked in a $400,000 loss that he never recovered from. Investor B started with $700,000 in stocks and $300,000 in cash. His stocks dropped to $420,000. Painful, but not devastating. And critically, he had $300,000 in cash to deploy. He bought methodically as the market fell. Deployed all his cash between October 2008 and March 2009, bought incredible businesses at fire sale prices. His cost basis on those purchases was roughly half of what those businesses had traded at just months earlier. By 2019, 11 years later, Investor A had rebuilt his portfolio to about $800,000, still below where he'd started before the crisis. A lost decade. Investor B's portfolio was worth over $3 million. His deployed cash had compounded at enormous rates during the recovery. His discipline during the boom and his courage during the bust had transformed his wealth. Same starting point. Same market exposure to quality businesses. Radically different outcomes. The difference, strategic cash management. That story, I've seen variations of it play out dozens of times across multiple market cycles. The names change, the specific assets change, but the pattern is always the same. Disciplined cash holders build lasting wealth. Fully invested optimizers get destroyed during inevitable crashes. Not because they're bad investors, not because they're unlucky, but because they don't understand the strategic value of cash. Now, as we near the end of our journey together, I want to leave you with the deepest wisdom about cash, the wisdom that transcends strategy and enters the realm of philosophy. Cash is not really about money. It's about freedom. It's about power. It's about peace of mind. It's about being prepared. It's about having options. It's about sleeping well at night regardless of what markets do. The person with substantial cash reserves lives differently. They make different decisions. They experience less stress. They have more confidence. They're more generous because they're not desperate. They're more patient because they're not pressured. They're more successful because they're operating from strength rather than weakness. This extends far beyond investing. It affects every area of life: career decisions, business opportunities, personal relationships, health choices, everything. Because when you have cash, you have time to think, time to choose, time to wait for the right opportunity rather than accepting whatever comes along. And time is the ultimate currency, more valuable than money itself, because you can always make more money, but you can never make more time. Cash buys you time, in markets, in life, in everything. That's the ultimate lesson. That's why cash is king, not because holding it maximizes short-term returns, but because it maximizes long-term outcomes, financial outcomes, psychological outcomes, life outcomes. The investor who understands this, who truly internalizes this wisdom, becomes different, better, stronger, more capable, more successful, not just in investing, in everything. Because the discipline required to maintain strategic cash positions, the patience, the courage, the long-term thinking, the ability to resist short-term temptations, these qualities transfer to every domain of life. You become someone who can delay gratification, who can think independently, who can stay calm under pressure, who can act decisively when others freeze, who can see opportunities where others see only danger. That transformation, that's the real value of understanding cash. Not the money you'll make, though you'll likely make plenty, but the person you'll become in the process. A person of substance, of wisdom, of strategic thinking, of calm confidence. That person, that's who builds lasting wealth. That's who creates generational prosperity. That's who lives with peace and purpose and power. And it all starts with something as simple as holding cash. Strategic, disciplined, patient cash holdings. The ultimate weapon in the investor's arsenal. The foundation of unshakable financial strength. Cash is king. Always has been. Always will be. Not as an end in itself, but as a means to something far greater. Freedom, opportunity, peace, power, wisdom. That's what cash truly represents. That's why you must always hold it. That's why it matters more than any other single principle in investing. Remember this, live this, and you'll never be at the mercy of markets again. You'll be positioned to exploit them, to profit from them, to build lasting wealth through them. That's the promise of strategic cash. That's the power you now hold. Use it wisely, use it patiently, use it courageously, and watch your entire financial life transform.